At the 2 o'clock mark, I'll start and then I'll kind of wait until we get I get confirmation.
Okay.
Okie doke. Good afternoon, everyone. My name is Jasmine Butler, Administrative Director in Congresswoman Shontel Brown's office. Thank you all for joining us for our tax prep webinar. Due to some changes in the House's schedule, the Congresswoman has been called to the floor to vote. And so she won't be able to be with us in the beginning, but we're hoping that she'll be able to at least join at some point throughout the webinar. Nevertheless, we want to proceed with our scheduled time out of respect for your time. In a few moments, we will get started, beginning with a presentation from our special guest, Kate Hunyady from the IRS. Kate is a congressional liaison with the IRS and a tax expert who will share more information on key dates and the forms and resources you can use at irs.gov. Kate will also break down key tax credits like the child tax credit, the EITC, clean energy tax credits, and more. Following her presentation, we will also address some of the questions that were submitted in advance of this webinar. Keep in mind that this webinar is designed to share general information, and we encourage you to consult your own tax advisor when you file your returns. As you prepare your returns this year, we ask if you have any questions for you to contact our casework team here in the district. You can call 216-522-4900 or reach out to us by visiting shontelbrown.house.gov. Thank you all again for joining us. And with that, I will hand it off to Kate Hunyady from the IRS.
Okay, thank you so much. I really appreciate you having me today. Again, my name is Kate Hunyady. I actually work in the Office of Legislative Affairs at the Internal Revenue Service as a congressional district liaison, which you heard. Today, I'd like to share some information with you that will hopefully help you get prepared for the upcoming tax filing season. On Monday, the IRS announced that filing season will begin officially this year on January 29th. And with that, can we please go to the next slide? The due date for taxes to be filed and paid is April 15th, 2024. April 15th falls on a weekday this year, so there won't be any extra days. If it falls on the weekend, sometimes we get a little extra time to file, but that is not the case this year. So April 15th is the deadline. If you choose to file an extension, this must also be done by April 15th, and the extended due date is October 15th, 2024, which incidentally also falls on a weekday. Please note that if you choose to request an extension, it only extends the time to file. It does not extend the time to pay. So if you do request an extension, you must still pay any tax due by April 15th. Speaking of filing, I have some suggestions to help you get ready that I hope you will find helpful. First and foremost, organizing your tax records for the year is key. This is because organized tax records make preparing a complete and accurate tax return much easier. And if you have a tax return preparer, I'm sure that they would tell you the same thing. It helps avoid errors that lead to delays, which can in turn lead to delays in receiving your refund. And reviewing your tax records may also help you find overlooked deductions or credits that you qualify for. Examples of tax documents that you should receive and compile prior to filing include Forms W-2, which you would get from your employer, Form 1099, which you might get for things like work as an independent contractor or unemployment compensation. You might also get one if you receive dividends or if you had a distribution from a retirement plan or an annuity. If you received interest, you might get a Form 1099 INT. Records of digital asset transactions, for example, Bitcoin transactions might be helpful for you to have if there are taxable transactions involved. Another example is a Form 1095A. This is a health insurance marketplace statement. You need this form to reconcile advance payments of the premium tax credit for the 2023 marketplace health insurance coverage for 2023. IRS or other agency letters that might have an impact on taxes should also be gathered. If you use an identity protection PIN or IP PIN to help ward off identity theft when you file your return, you should have received a CP01A notice from the IRS already. So that would be something helpful to have, as you will need it to file. In fact, you cannot file electronically without that IP PIN if you are in the IP PIN program. Another example, if applicable, would be mortgage interest statements or records of any charitable contributions that you made throughout the year. Another part of your preparation, in addition to gathering those forms and documents, would be to review your IRS individual online account. Taxpayers with a Social Security number or an individual taxpayer identification number, or ITIN, can create or access their individual IRS online account to get information that they need to file their return. With the online account, you can view any balances that you owe currently. You can view your payment history, as well as schedule payments for any upcoming amounts that you might owe. You can also cancel scheduled payments that you've already made. This is actually a new feature for the 2024 year. You can get transcripts of prior year filings. You can view or create payment plans if you need to. You can also see digital copies of some IRS notices. So if you received a notice from the IRS in 2023, you may be able to view a copy of it in your online account. You can also view data from your most recently filed tax return, including the adjusted gross income figure, or AGI. Sometimes we ask for that to verify your identity. Sometimes when you're filing, an e-file software program may ask for that number as well. So it's handy to be able to access it there. You can also validate bank accounts and store multiple account information when you're setting up payments, which eliminates the need to re-enter your bank account information each time you want to set up a payment there. You can also view, approve, and electronically sign a power of attorney or a tax information authorization form from your tax professional if you want to have someone represent you before the IRS in an IRS matter. Those are two of the forms that you could use to authorize them to do so. And in your online account, you can sign those forms electronically. In addition to your online IRS account, irs.gov has many online tools to help you. The tools are easy to use. They're available 24 hours a day. Millions of people use them to help file and pay taxes, to track refunds, to find account information, and even to get answers to tax questions. Next slide, please. So I thought I would let you know about some of the online tools available to you. The first is IRS Free File. Many people are eligible to file electronically for free at irs.gov or using the IRS To Go mobile app. The IRS Free File program is available only through irs.gov. It does offer eligible taxpayers brand name tax preparation software packages to use at no cost. And some of the Free File software even offers free state tax return preparation as well. The software does all of the work to find the deductions, credits, and exemptions that you qualify for. So it's pretty easy to use. If you don't qualify for the Free File program, but you're comfortable preparing your own taxes, irs.gov also offers online fillable forms, and you can just input your tax information there yourself, and you can e-file those, or you can print them out and mail them in. If you prefer to get help with taxes and you qualify, you can use the VITA locator tool to find locations for the IRS's volunteer income tax assistance programs. That's what VITA stands for. And that also is combined with another program called Tax Counseling for the Elderly, or TCE. VITA and TCE both offer free basic tax return preparation to qualified individuals, and the VITA locator tool will help you find an open VITA site near you. If you check it out now, there may not be information available since filing season hasn't begun, but it's definitely worth looking into as we approach filing season. I think you just put in a zip code and then the distance you're willing to travel, and then a list of open sites will pop up there for you. VITA provides assistance to people who generally make $60,000 or less, persons with disabilities, and limited English-speaking taxpayers. And the TCE program offers free tax help, particularly for those who are 60 years of age or older, and it does specialize in questions about pensions and retirement-related issues that are unique to seniors. For those of you who don't qualify to receive assistance with VITA, the IRS does have a tool to help you find a tax professional as well. It's called the Directory of Federal Tax Return Preparers with Credentials and Select Qualifications. This can help you find a tax return preparer in your area who currently holds a professional credential, which is recognized by the IRS. This would include an enrolled agent, a certified public accountant, or a tax attorney. Preparers should be skilled in tax preparation and accurately filing income tax returns. You do trust them with your most personal information, such as your marriage, your income, your children, social security numbers, and pretty much all the details of your financial life. So you want to be really careful in selecting a good preparer to help you with that. Please note that the IRS does not endorse any particular preparer. Our directory simply shows preparers in your area who do hold a professional credential that we have verified, but we aren't suggesting that they are necessarily good or bad. So do keep that in mind. Next, if you have general tax questions, you can try the Interactive Tax Assistant, also called ITA. That's at irs.gov as well. This is a tool that provides answers to many tax law questions. For example, it can help determine if a type of income is taxable. It can help you determine if you're eligible to claim certain credits or deduct certain expenses on your tax return. It also provides answers for questions such as what your filing status should be, if you can claim qualified dependents, or even if you have to file a tax return. You can also use the ITA to find out if life event changes make you eligible for credits that you maybe previously didn't qualify for. Next slide, please. Self-employed individuals have some extra considerations when preparing for filing season, and the IRS has a page dedicated to providing guidance and resources for these individuals. It's called the Self-Employed Tax Center. There's information there about self-employment income, tax return forms, which are specific to self-employment, record keeping, starting a business, and much, much more. It has links to online learning, such as webinars and small business tax workshops. And the IRS has also made many improvements to customer service throughout this past year, which are available to all individuals, self-employed or not, but some of them have been made with small business taxpayers in mind. So I just wanted to mention those as well. Improvements include more phone assisters to answer questions for both individual and business taxpayers, expanded online service tools, which includes a business online account, which is designed with small business taxpayers in mind. Like I said, it's similar to the IRS online account for individuals that I mentioned earlier. Small businesses can also use their business account to see tax information, to schedule and track payments. They can also access their business tax transcripts, and they're in an easy to read format. That's something we have changed. Sometimes our transcripts are hard to understand, but we have worked to make them easier for someone to understand. We also plan to continue to add more features to the business online account throughout 2024. Another upgrade is we are now offering more ways to respond to notices as well as to file documents. Individuals and small business owners both are able to respond to certain notices sent from the IRS online rather than having to mail in the information. Some examples are notices for a missing signature, correction of self-employment income, and employment-related identity theft notices. We've also created simplified mobile-friendly forms, which will allow individuals to file forms on their phone if they choose. Small business owners will also find that some commonly used small business forms like 940s, 941s, and 944s are simplified and are also mobile friendly. They are also available in multiple languages. Another great improvement for business taxpayers is the ability to file electronically any Form 1099 series information return for free with the IRS Information Return Intake System, or IRIS. IRIS accepts 1099 series forms for tax year 2022 and after. It's available to any business of any size. It's secure, it's accurate, does not require any special software. IRIS allows business taxpayers to enter information directly into the portal or to upload files. You can download completed copies of the forms that you filed. You can submit extensions. You can make corrections to forms that you have already filed within IRIS. You will also be notified immediately of input errors or missing information. And you can get a confirmation in as little as 48 hours that the IRS has received the 1099s that you filed. This system reduces expenses for paper, postage, storage, and trips to the post office, among others. So it's a really helpful system if you have to file 1099s. Another helpful online resource available to all individuals, self-employed or otherwise, is access to IRS publications and forms. These are searchable at irs.gov. Most can be downloaded and printed directly from the internet as needed. You can search for a publication or form by a keyword. So if there's something that you are wondering if we have a publication for because you'd like more information, you can put that keyword in and search. In addition to reviewing or downloading the forms, you can also request that the IRS mail copies of the forms or publications directly to you. You just input your address and then we get them out. Usually it's within 10 business days. Last but not least, for online resources, of course, our most popular online tool at irs.gov is the Where's My Refund application. This, of course, allows you to check the status of your refund. And I would be remiss here if I didn't mention that the most efficient way by far to get your refund is to file electronically and then also to request a direct deposit into your bank account. Paper checks take longer to issue, much longer to issue, and they're also subject to issues like non-receipt, theft, and forgery, or checks being returned because of an incomplete or bad address. If you need it, the IRS does have information about how to open a bank account if you don't already have one. Next slide, please. All right, we're going to change gears a bit here. Now that you have some information about preparing to file and some resources to help you with that, I'd like to tell you about some popular tax credits as well as a couple new ones that are available this year. First, let's talk about the Child Tax Credit, or CTC. This helps families with qualifying children to reduce their tax liability. You can claim the child tax credit for each qualifying child who has a Social Security number that is valid for employment in the United States. Might sound funny, a child isn't obviously working, but we actually have Social Security numbers in the US that are not valid for employment and those that are. And for our purposes at the IRS, a qualifying child must have a Social Security number that is valid for employment. So I just wanted to mention that. Also, to be a qualifying child for the 2023 tax year, the dependent generally must meet the requirements that you see here on the slide. For example, be under the age of 17 at the end of the year, provide no more than half of their own financial support during the year, have lived with you for more than half the year, etc. In addition to these that you see, a qualifying child must also not file a joint return with their spouse for the tax year, or if they do, it can only be filed to claim a refund of withheld income tax. And the qualifying child must also be a US citizen, a US national, or a resident alien of the US. To qualify for the full amount of the child tax credit, which for 2023 is $2,000 per each qualifying child, you must meet all of the eligibility factors that we talked about, and your annual income cannot be more than $200,000. That's for an individual filer. For a joint return, the income cannot exceed $400,000. Parents and guardians that have higher incomes than the $200,000 or the $400,000 may be eligible to claim a partial credit. The full amount of the credit does begin to be phased out once you exceed the income limits, but you may be able to claim a partial credit if your income does exceed the limits. So be sure to take a look at that. You can check your eligibility for the child tax credit using our interactive tax assistant that I mentioned earlier, the ITA. That you're going to actually hear about the ITA several times today. So it is a very helpful resource. And you claim the child tax credit by entering your children on Form 1040, which is the US individual income tax return. And then you would complete a Schedule 8812, which is credits for qualifying children and other dependents, and you would attach that to your return as well. If you're e-filing, the software will walk you through that, so you don't have to worry about remembering all the individual form numbers. Next slide, please. Okay, moving on to the Earned Income Tax Credit. This credit helps low to moderate income workers and families get a tax break. If you qualify, you can use the credit to reduce the taxes you owe and even increase your refund. That's because the Earned Income Tax Credit is what we call a refundable credit. So it first reduces your tax liability, but if there is excess credit that you are not getting the benefit of by reducing your tax liability, then you would get the excess in the form of a refund. So it can actually increase your refund. The child tax credit is also a refundable tax credit up to $1,600. I didn't mention that, but I wanted to. So determining eligibility for this credit can be a little complicated. There's a lot of considerations. I do suggest checking out irs.gov to get information and to make sure that you do qualify, and if you do, you want to make sure that you claim it. There's actually an eligibility tool available at irs.gov to assist you. It will ask you questions, and based on your answers, it will let you know if you qualify. Generally, the basic eligibility factors are those that are listed here on the slide. For example, you must have worked and had earned income under $63,398. Your investment income should be below $11,000 for 2023. You must have a valid Social Security number by the date of your 2023 tax return. You must also be a US citizen or resident alien for the entire year. There are some special rules for joint filers, and essentially, if you are married or you are a registered domestic partner and you file separate from your partner or spouse, you cannot qualify for the Earned Income Tax Credit unless you had a qualifying child who lived with you for more than half of the year. And you must also have lived apart from your spouse or domestic partner for the last 6 months of 2023. So if you are in that situation where you're filing separately from a partner, please do make sure that you are claiming the EITC if you do qualify. Next slide, please. There are special rules for members of the military, clergy, and taxpayers with disabilities. Also, While many who claim the EITC do have at least one qualifying child, you are eligible to claim it without a qualifying child if you meet the rules, all of the following rules that you see here. If you're filing jointly, both you and your spouse must meet all of the rules. And these include all of the basic qualifying rules we just went over. You must also have your main home in the US for more than half of the year. This includes the 50 states, the District of Columbia, and US military bases, but it does not include US possessions such as Guam or the Virgin Islands. You also cannot be claimed as a qualifying child on anyone else's tax return, and you must be at least 25, but under the age of 65. On this slide, you can see the maximum credit amounts as well as the income limits for the number of qualifying children. So I'll give you a moment to look over that, a brief moment. You probably have been looking at it already. Okay, next slide, please. And here we have a list of resources that are available on irs.gov, as well as several applicable IRS publications where you can get more information about the Earned Income Tax Credit. I'll give you a minute to review those as well. Okay, next slide, please. Okay, now we're going to move on from two of our existing credits to a few new ones involving clean energy. I do want to warn you from the outset that we are going to get a little bit more in depth with these credits because they are new, and they are, especially the residential clean energy credits, are a little bit more complicated. They're not as straightforward as something like the child tax credit. So bear with me. It's going to be a lot of information, but I'll walk you through it. I'll give you an example, and hopefully it'll be helpful, and you'll feel like you understand when we're done. So first, I'm going to talk about the residential energy credit, and then I'm going to talk about the credit for clean vehicles. As you can see on this slide, both of those have two parts. The residential clean energy credit and the energy efficient home improvement credit comprise the residential energy credit. And then for the clean vehicle credits, we have the new clean vehicle credit and a previously owned clean vehicle credit. Our conversation today is focused only on individual taxpayers claiming the credits on a 1040 series federal income tax return. We're not going to talk about these incentives for businesses, nonprofit groups, or other entities. There is information available on those at irs.gov. So if you're interested, I recommend checking that out. Next slide, please. Okay, first we have the residential clean energy credit. This credit is for installing solar panels, solar water heaters, wind turbines, geothermal heat pumps, fuel cells, and beginning in 2023, costs paid for battery storage may also qualify. The current amount of the credit that you can take is 30% of the qualified expenses paid, and the credit does include the cost of installing the product. Also, for taxpayers who are considering purchasing one or more of these systems, you should know that the residential clean energy credit is non-refundable. You might remember I spoke about this with the earned income tax credit. So, excuse me, unlike the EITC, which is refundable, these credits are not. So they will reduce your tax liability all the way down to zero. But if you have excess credit left over, it will not be issued to you in the form of a refund. So that's something I want to mention. The residential clean energy credit, however, does have a carry forward provision. So if you're not able to use the entire amount in the current year, you can carry it forward and use it to offset tax liability in a future year, which is a good thing. So that's part one of the residential energy credit. The second part is the energy efficient home improvement credit. This is also a 30% credit, but this applies to qualified expenses paid for energy efficient home improvements, such as those listed here. For example, exterior doors, windows, skylights, insulation, a biomass stove or a biomass boiler, and home energy audits. Next slide, please. The energy efficient home improvement credit, as I mentioned, is 30% of the qualified costs. It is a maximum of $3,200 per year. So taxpayers can claim the credit only for the qualified expenditures incurred for an existing home or for an addition or renovation to an existing home. The credit does not apply for newly constructed homes. Please note also that this slide illustrates some types of energy efficient home improvements that are subject to a $1,200 max credit, while other appliances are subject to the $2,000 max credit. So that's how we get the $3,200 maximum credit, the $1,200 plus the $2,000. There's two separate categories, and we are going to talk about that. If you look at the bottom half of the slide, these are the energy efficient appliances that make up the $2,000 part of the total credit. The other upgrades are subject to a $1,200 maximum credit, but it does get a wee bit more complicated. Each of those in the $1,200 category is subject to its own separate limitation. So let's take a look at the specific limitation for the various types of upgrades, and hopefully you are not completely having your mind blown at this time. Next slide, please. Okay, so we see several categories of items here: building envelope components, qualified energy property, and home energy audits. The first three categories on the slide, which I just mentioned, are all combined together, but the total credit for those three categories cannot exceed $1,200. And then each specific upgrade, like I said, has its own separate limit. So let's take a look at the building envelope components. The credit for the energy efficient exterior doors is a maximum of $500. That is further limited to a max of $250 per door. So just want to mention that as well. Then you have a max annual credit for exterior windows and skylights of $600. And then the max credit for insulation is 30% of the cost up to $1,200. If you look at the second category, the qualified energy property, you'll notice for all of those items, the air conditioners, the heaters, the boilers, electrical panel upgrades, all of those are subject to the same limit, and that is the $600, 30% of the total cost up to $600. Then we have the home energy audits. These are their limitation is $150. So let's walk through a practical illustration, and hopefully this will help it make sense. So the max credit for insulation is $1,200, like we mentioned, but that is also the max credit for all three of those categories combined. So if someone installs $4,000 worth of insulation, their credit would be 30% of the $4,000 or $1,200. And then they would be maxed out for that part of the credit because they would already be at the $1,200 limit. However, if they, during the same year, they purchased one of the other items listed in the top three categories, they would not get additional credit because they're already at the $1,200 threshold. But they could install one of the items that's in the $2,000 bracket. So a heat pump, for example, this would be used to heat and cool their home. They would have maxed out both parts. They would have the $2,000 from the heat pump and the $1,200 from the insulation to give them their max credit of $3,200. So let's say the taxpayer in our example is smart and they want to maximize credits and they understand how to do this over multiple years. So let's say next year in 2025, the same taxpayer might install energy efficient windows. You might recall the limitation for windows is the $600. And then they might also install energy efficient doors, 2 of them, and that there is a $500 limitation for those. So now they're at $1,100, $600 from the windows, $500 from the doors. So if they had an energy audit done, they might qualify for up to $150. However, they're already at $1,100 and the max is $1,200. So they'd be able to use $100 from the home energy audit, but they would lose that extra $50. Then let's say they purchase a heat pump hot water heater. So again, now they have the potential credit of up to $2,000 because the water heater is in the $2,000 category. So they could combine their doors, windows, and home energy audit of up to $1,200 with their heat pump hot water heater, $2,000, once again, maximizing the credit for the following year, again, at $3,200. Now, the building envelope component costs do not include the cost of installation, but the other three do. I just want to mention that. Also, if you have rental property that you rent out, you are eligible to claim costs for qualified items as well, including central air conditioners, natural gas, propane, or oil, water heaters, furnaces, and boilers, electrical panel and circuit upgrades, and home energy audits. All right, next slide, please. Here on this slide, we have some residential energy credit resources. The first item, irs.gov/home energy, is an excellent starting point if you're considering some of these home energy improvements. And this is the main irs.gov landing page for the residential energy credits. From here, you can actually navigate to many of the other resources that are listed, including the FAQs and the Form 5695, which is the form that you use to claim the residential energy credit. We've also included links for EnergyStar.gov and Energy.gov because these are great websites that contain information on the credits and the types of improvements and appliances that qualify. Next slide, please. All right, let's take a deep breath. Now we're going to talk about the credit for new clean vehicles, and this one is much more straightforward than the residential energy credits. So there aren't separate limits for different components. So hopefully you are still willing to listen and hear about the credit for new clean vehicles. This is a credit of up to $7,500. It's for qualified vehicles purchased during the tax year. The last item on the slide explains that this credit is also a non-refundable credit again, so you won't be able to increase a refund. And the vehicle credit does not offer a carry forward provision like the residential energy credit did. So it's just a one and done type of credit. Next slide, please. Here we will see some additional requirements for qualified vehicles. Your vehicle must have a battery capacity of at least 7 kilowatt hours, gross vehicle weight rating of less than 14,000 pounds. It must be made by a qualified manufacturer. And lastly, the vehicle must undergo its final assembly in North America. There is a published list of qualified vehicles and manufacturers at fueleconomy.gov, and irs.gov has a link that will take you to that site. Once you go to the fueleconomy.gov, you can actually find a link that will take you to the Department of Energy's page on electric vehicles with final assembly in North America. And there's a VIN decoder tool there. So you can actually input the VIN number from a particular vehicle there, and it will tell you if the car is qualified. It'll address all of the qualifications. So that's pretty cool. Sometimes that final assembly piece is hard to find. You can sometimes Google or get the information for the other three more easily, but the final assembly location is harder to find. So that VIN locator decoder tool is a great resource. Next slide, please. All right, now we're going to talk about the credit for previously owned clean vehicles. The credit limits and requirements are a little bit different. For example, the maximum amount of the credit is the lesser of $4,000 or 30% of the sales price. There's that 30% figure again. It's very popular with the clean energy credits. This credit is available to all qualified buyers who are not claimed as a dependent on someone else's tax return. And qualified buyers can only claim the credit once every 3 years. And then the sale price of the previously owned vehicle must be less than $25,000. Next slide, please. You can qualify if you are an individual who bought the vehicle for use and not for resale. You cannot be the original owner. As I said, you cannot have claimed another used clean vehicle credit in the previous 3 years. Also, the vehicle must have a model year that's at least 2 years earlier than the calendar year when you buy it. So for example, if you buy a used vehicle in 2024, the model year must be 2022 or earlier. And also, there are modified adjusted gross income limitations. This is a figure that you would determine at the time of filing your tax return. You can get information for computing the modified adjusted gross income on irs.gov if you want to make sure that is not a concern. And lastly, you must purchase the vehicle from a dealer. Next slide, please. All right. The last thing I want to talk about is the elusive 1099-K. I say that because the rules surrounding this form seem to keep changing, so I want to clarify what the current guidance is. First, I'll tell you what is a 1099-K. This is a report of payments that you got for goods or services during the year from payment apps or online marketplaces, also called third-party settlement organizations or TPSOs. This includes payments for any goods that you sell, including personal items like clothing or furniture, services you provide, or property you rent. Payments can be made through platforms like payment apps, craft marketplaces, an auction site, a car sharing or ride hailing platform, a ticket exchange, a crowdfunding platform. Those are all examples of TPSOs where you might receive payments like this. If you accept payments on different platforms, you could get more than one 1099-K. Personal payments from family and friends should not be reported on a 1099-K because they are not payments for goods or services. For example, sharing the cost of a meal, getting a birthday gift in the form of cash, or getting repaid by a roommate for rent. Those should not be included on a 1099-K. Next slide, please. So that's what the 1099-K is. And the threshold for companies, for these TPSOs to report these transactions had been $20,000 in payments from over 200 transactions for goods or services. But in 2021, when Congress enacted the American Rescue Plan, that $20,000 threshold was reduced to $600, so a significant change. What that would mean was that companies would issue the 1099-Ks for transactions totaling at least $600 for the year. The change was expected to be implemented this year, so for 2023, and therefore the 1099-Ks would begin to be issued in this month, in January. However, and this is the important part, and this is why I'm talking about it, following feedback from taxpayers and tax professionals and the payment processors, the Internal Revenue Service announced that that $600 threshold would be delayed again for the calendar year of 2023. Instead, 2023 will be treated as an additional transition year. And what that means essentially is that these companies do not have to report transactions based on the $600 threshold. They are still subject to the $20,000 threshold. And then we expect that for 2024, the threshold will be decreased to $5,000. And then in 2025, we will get to the $600 threshold as directed by the American Rescue Plan. Okay, now I feel like I need to say that the decision to delay the implementation was made pretty late in the year. So I would suspect that many of the TPSOs that are required to issue the 1099-Ks are already set up to do so for the $600 threshold. So many people will probably receive them this filing season, despite the fact that the implementation has been delayed. You know, regardless of what the 1099-K threshold is, there really are no changes to what counts as income and how it's calculated. So no matter the amount, if you're receiving taxable payments for selling goods or services or renting property, you should be reporting the income anyway. If you are a gig worker, a freelancer, a hobby seller, or otherwise self-employed, the 1099-K payment information would be reported on a Schedule C. Again, whether you receive the 1099-K or not, that's where it would be reported. I just want to mention, if you do get a 1099-K when you shouldn't have, you need to contact the issuer immediately. They need to issue a corrected 1099-K that would show a zero amount. The IRS cannot correct the 1099-K for you. If this happens to you, do keep a copy of the original form and all the correspondence between you and the issuer. Also, do not wait to file your taxes until you get the corrected form. We don't want you to incur late filing penalties because you were waiting on that corrected 1099-K. The IRS does have a plan in place for you to report an erroneous 1099-K reporting. You can find information about this on irs.gov, but I do just want to mention it here. I don't expect you to remember it, but hopefully if this happened, if you find yourself in this situation, you'll, oh yeah, I heard about that. So the 1040 has a document called a Schedule 1, and you would report the error in Part 1 of the Schedule 1 on line 8Z in other income, and you would write Form 1099-K received an error, and you'd report the amount. And then you also have a corresponding part, and that would be also on Schedule 1, but Part 2, line 24Z, you would report same thing, Form 1099-K received an error and the amount. These two entries will cancel each other out. The net effect would be zero. And so it won't affect your adjusted gross income or your tax liability, but it will let the IRS see that you're reconciling the 1099-K payment that you received on the return. So I just wanted to make sure I covered that. And with that, I'm finished. And on the next slide, I am open to questions. So I will go ahead and turn it over for questions.
Thank you, Kate. We did have some questions that were brought in, submitted in advance. And the first one is, where are the QCD or qualified charitable distribution amounts reported on Form 1040 SR for 2023?
Okay, so the simple answer is that the QCDs are reported on line 4 of 1040 as well as 1040 SR. I do want to mention that if you report this, whether all or part of the IRA distribution is a QCD, you would report it on the same line. It would go on 4A. And this is the amount that is shown in box 1 on the 1099-R. So if the full amount of that distribution is a QCD, then you would put the full amount on line 4A, and then you would enter 0 on line 4B. If only part of box 1 is a QCD, then you would put that amount on 4A and you would put the difference on 4B. Either way, be sure to enter QCD next to line 4B so we know what it is.
Thank you. Our next question is, I separated from my company in 2023 and took a withdrawal from my 401k plan. Can my withdrawal be eligible for the distribution without penalty with the 55 age rule in the year you separated service? If so, what form do I use?
Okay, so I want to say that I'm unable to provide guidance for a specific situation for specific tax circumstance, because I don't have all of the facts and circumstances that would need to be considered. A lot of the tax law has has nuances and exceptions to the rules. So what I can provide, and I can do that for this question, is the general guidance, and then you can see if it applies for your particular situation. So generally, the 10% tax does not apply to distributions that are from a qualified retirement plan other than an IRA after you separate from service in or after the year you reach age 55. The IRS publication 575 has additional information on this. And as for the reporting piece, the additional tax, if it was applicable, is typically reported on Schedule 2 of the 1040. So I would suggest if you if you meet the qualification for the exception, so if you do not have to report it, I would just put a 0 on the Schedule 2 in that line. There is one other piece of the puzzle here, though. If you do qualify for the exception, you need to look at your 1099-R when you get it, which will show the distribution. If your 1099-R does not show a distribution code of 2, 3, or 4, then you must also complete a Form 5329. Again, you could look for those distribution codes when you receive your 1099-R. If it shows a distribution code of 2, 3, or 4, then you're good to go with Schedule 2. But if not, you do have to report on or complete a Form 5329.
Thank you. The next submitted question is, I cared for a minor child for 7 months, and I want to claim him on my taxes. I have a temporary POA or power of attorney. What steps do I take? Can the mother claim him for other months? And should I inform her of my plans?
Okay, so same thing for this one. I will try to give you the general rules, and then you can see if your particular situation applies. I'm assuming that in this question, the constituent is referring to claiming the child as a dependent on his or her tax return. If so, I would highly recommend checking out the Interactive Tax Assistant. Again, there it is again. It has an entire section on dependents and who qualifies. Without knowing all the facts and circumstances here, I would also recommend checking out publication 501 for more information. So dependents must either be a qualifying child or a qualifying relative. If the child is not a qualifying child, then he or she must live with you as a member of your household for the entire year in order to qualify. So in this case, it doesn't sound like the child did live with you for the entire year, since you mentioned that you cared for the child for 7 months. So we can rule out the qualifying relative. That means that the child must meet the qualifying child requirements. And here they are. The child must be one of the following: your son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of those. The child must be under the age of 19 at the end of the year and younger than you. Or if they are a student, they must be under the age of 24 at the end of the year, but still younger than you. If the child is permanently or totally disabled, they can be any age. The child must have lived with you for more than half the year. The child must not have provided more than half of the child's own support, financial support, and the child must not be filing a joint return for the year in question. Sometimes a child does meet the relationship age, residency support, and joint return tests to be a qualifying child of more than one person. If that is the case, generally only one person can actually treat the child as a qualifying child. So no, the mother would not be able to also claim the child for the portion of the year that she cared for the child. So, you're not able to just come up with an agreement to divide the tax benefits between more than one person, unfortunately. As I mentioned, publication 501 is a great resource. It actually discusses what we will call tiebreaker rules. that can help you determine which person is entitled to claim the child as a dependent. In this situation specifically, since you cared for the child for 7 months, it doesn't sound like the mother, that you and the mother are both going to be eligible to claim the child. So if the other requirements are met, then it sounds like you would be the one that's eligible to claim the child. Whether or not you choose to tell the mother is up to you. But I will warn you, if you both claim the same child on your tax return, it will be an issue that needs to be resolved before both tax returns can be fully processed. The IRS will ask for documentation to verify which one of you is the eligible individual to claim the child. So hopefully that helps.
Thank you. The next question submitted is, where can I find the IRS 2023 Social Security tax calculator for Form 1040?
Okay, so I assume that this question is referring to the taxability of Social Security benefits and whether or not a particular amount is taxable. If so, again, you can use that handy dandy interactive tax assistant tool. In order to find it, you could go to irs.gov, type in interactive tax assistant in the search bar. When you get the results from your search, you would click on the interactive tax assistant link. It should be the first one that comes up. Once you're there, you can scroll down halfway through the page and you'll see a heading called Retirement, Pensions, IRAs, and Social Security. And under there is a link called Are My Social Security or Railroad Retirement Benefits Taxable? If you click on that, that will take you to a page with a calculator that will help you determine if your Social Security is taxable. I hope that's what you were asking about.
Thank you. And our final question is a little bit more lengthy. It is, I have the responsibility of preparing a Form 1041 for my father's trust for calendar year 2023. When my father died in 2023, his trust inherited all of his IRA accounts. My father had a basis in his IRA balance and had filed for 8606 in prior years to compute the portion of the RMD that was not taxable. The trust was required to take a distribution in 2023 because my father had not taken one before his death. I cannot find any instructions that tell me if the remaining basis on his 2022 for 8606 also passes to the trust.
Okay, so I have to say that IRAs and trusts and inheritance are all three very complicated tax issues in and of themselves. And when you combine them together, it gets even trickier. So as I mentioned earlier, it's really hard for me to weigh in on a specific situation without having all of the facts and circumstances, and that certainly applies here as well. What I can tell you is that the general rule for an inherited IRA is that the basis stays with the IRA. So whatever the basis in the IRA was to the original owner, the inherited owner would maintain the same basis generally. So hopefully that's helpful in terms of determining what the basis would be to the trust. As far as reporting it on the 1041, again, that's something I really can't advise on without having more information. I would recommend for this situation consulting with a tax professional. There are those that specialize in trusts and also in inheritance of IRAs and other items as well. So I'm sorry I can't be more definitive about that, but hopefully the basis part is helpful.
Thank you, Kate. And with
Sure.
that, I am excited to introduce Congresswoman Shontel Brown, who will close us out. Congresswoman.
Thank you. Hello, everyone. This is Congresswoman Shontel Brown. Before we conclude today, I just want to thank you all for joining us and thank Kate for her presentation today. Thank you, Kate. Kate, you were amazing. We all know that filing your taxes can be stressful, but the good news is there's still time. That's what this webinar is all about, preparation. And hopefully, with a little bit of preparation, we can take some of the stress out of tax time and you can take full advantage of some of the tax credits available to you and your family. And we want to make sure that folks in Northeast Ohio know that there are resources available to help you. If you have questions about your taxes, if you need help contacting an agency, please, please, please contact us. Whether it's the IRS or another federal agency, we can help. Last year, I'm proud to say my office returned over $2.7 million to constituents through casework, and a big part of that was IRS cases. So you can visit shontelbrown.house.gov and click contact, or you can call 216-522-4900. That's 216-522-4900, 216-522-4900. Thanks again, and I hope that all of you have a wonderful week.